Today, we're doing a complete breakdown of ASC 360. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine holding a $10 million asset that suddenly loses value, but remains unchanged on your books. ASC 360 tackled this exact issue, forcing companies to reflect true asset values through impairments. Now, any significant decline is transparently reported. Understand how this standard ensures financial statements reveal genuine asset worth. ASC 360 exists because assets were often valued at historical cost, not reflecting their true economic value. This could lead to significant misrepresentations on financial statements. By introducing regular impairment testing, the standard compels companies to acknowledge when an asset's recoverable amount falls below its carrying value, promoting transparency. For example, a manufacturing plant once worth $15 million might now only recover $8 million. Under ASC 360, this impairment must be recognized, ensuring that reported asset values are accurate. From 2002, ASC 360 became mandatory for any company with long-lived assets. This includes manufacturers, retailers, and service providers, essentially everyone dealing with property, plant, or equipment. The crux of this standard is its impairment testing requirement. When an asset's fair value drops below its carrying amount, companies must write down the asset. Imagine a company with $20 million in equipment, now only worth $12 million. ASC 360 ensures this $8 million discrepancy is recorded, offering stakeholders a clear picture of financial health. The asset impairment model within ASC 360 is a cornerstone of asset valuation. It ensures assets are not overvalued, reflecting their fair market worth rather than historical costs. This involves calculating expected future cash flows. If these fall short of the asset's book value, an impairment loss is recorded. Consider a fleet of trucks once valued at $5 million, now generating less revenue. Interviewers often test candidates on this model, as it showcases a deep understanding of asset management principles. Understanding the scope of ASC 360 is crucial, because many candidates mistakenly think land is included, but it's not. This common error can be a costly trap during interviews. The standard specifically addresses tangible assets used in operations, but excludes others like indefinite life intangibles. Knowing these distinctions not only keeps you aligned in practice, but also sharpens your interview strategy. ASC 360 explicitly targets tangible assets like machinery, buildings, and equipment. These assets are pivotal for production or services. For instance, factory machinery directly influences output, making it a key component of this standard. Recognizing these inclusions ensures accurate financial reporting and aligns with operational realities, a critical aspect often tested in interviews. ASC 360 excludes certain assets, like land and indefinite life intangibles, because they don't align with tangible asset depreciation needs. For example, land doesn't depreciate, so it's excluded. Assets held for sale follow ASC 360-10, ensuring clarity. These exclusions can trip up candidates during interviews, highlighting why precise knowledge of scope is vital. Carrying amount is the asset's net value on the balance sheet, reflecting original cost less depreciation. For instance, a $100,000 machine with $30,000 depreciation has a carrying amount of $70,000. This measure is crucial for understanding the asset's current book value, impacting decisions on asset utilization and replacement. It also plays a pivotal role in impairment testing and financial analysis. Impairment indicates when an asset's value falls below its carrying amount. Suppose a machine's carrying amount is $50,000, but future cash flows only support a $30,000 valuation. Impairment requires a $20,000 write-down. This adjustment is essential for accurate financial representation, ensuring assets are not overstated. Recognizing impairment impacts balance sheets and reveals insights about an asset's ongoing viability. Edge cases challenge ASC 360 application, testing your grasp of scope. Consider assets temporarily used in production. They still fall under this standard. Leased equipment, unless capitalized, might be excluded, adding complexity. Partially constructed buildings intended for operations are within scope, but assets reclassified for sale need special attention. Understanding these nuances can sharpen your interview readiness and practical application. Imagine spending millions on an asset that suddenly drops in value. ASC 360 addresses this risk by systematically testing for impairment, ensuring financial statements accurately reflect asset worth. It's a safety net for shareholders and managers alike, preventing overstatements that could lead to financial missteps. ASC's asset impairment model is a watchdog for asset value accuracy. Our example is Meridian Corporation's $10 million SaaS contract, with $8 million for software and $2 million for services. Each step scrutinizes potential impairment, safeguarding against financial overstatement. ASC's framework guides us from identifying asset groups to calculating possible losses, ensuring transparency and reliability in financial reporting. Meridian Corporation must first identify which assets generate independent cash flows. This means grouping the $8 million software license and $2 million implementation services as they operate as a unit. Misidentifying an asset group here can skew the whole impairment analysis. By defining the group correctly, Meridian lays the foundation for accurate impairment testing, crucial for financial transparency. Now, Meridian Corporation needs to determine the carrying amount of their asset group, which sums the $8 million software and $2 million services to a $10 million total. Forgetting associated liabilities can inflate this figure, misrepresenting true value. By adhering to ASC's guidance, ensuring all components are considered, Meridian steps closer to accurate impairment testing. Next, Meridian Corporation estimates the future cash flows for their asset group. They anticipate revenue based on software use and service consumption. Ignoring certain income streams here can lead to inaccurate assessments. ASC insists on using the best estimate of future cash flows, ensuring Meridian captures a realistic picture of the asset group's value moving forward. Meridian Corporation now compares their $10 million carrying amount to the projected cash flows. If the carrying amount exceeds these cash flows, it signals a potential impairment. Overlooking detailed analysis can lead to flawed conclusions. ASC's requirement for this comparison ensures any discrepancies between asset value and cash flow are identified, keeping financial statements trustworthy. Finally, Meridian Corporation calculates the impairment loss, since their $10 million carrying value tops expected cash flows. Missing relevant costs here can distort the impairment result. ASC guides using fair value less cost to sell or use, ensuring the calculated impairment accurately reflects financial health. Meridian keeps their financials in check by following these stringent standards. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 360 offers specific guidance on how to measure and what disclosures are mandatory. Understanding these can be the difference between a clear picture and a financial misstep. Initial recognition under ASC 360 means capturing assets at cost, which includes anything directly attributable like freight and installation. It's important that recognition only happens when future economic benefits seem probable and costs can be measured. For example, if you buy machinery for $100,000, every penny spent to get it operational counts toward its initial cost. Subsequent measurement under ASC 360 involves reducing asset values by accumulated depreciation and impairment losses. Imagine a $200,000 asset depreciating over 10 years. Each remeasurement could be triggered by factors like technological obsolescence. If a market decline suggests a $50,000 impairment, that needs immediate recognition to reflect accurate asset value. When presenting under ASC 360, assets show up as property, plant, and equipment on the balance sheet, minus accumulated depreciation. Depreciation impacts the income statement, reducing operating profit. Notes disclose key details like methods and impairment. For instance, a $10 million factory appears net of $2 million depreciation. Key disclosures under ASC 360 include depreciation methods, useful lives, and impairment losses. These are crucial for analysts to predict future expenses and assess asset quality. Imagine disclosing a $3 million impairment due to market conditions. This transparency helps investors gauge financial health. Disclosures also cover revaluation impacts and detailed asset class information, ensuring stakeholders have a full picture. Imagine a CFO managing a $500,000 machinery investment, adding $20,000 for installation, leading to a total initial cost of $520,000. Using straight-line depreciation over 5 years, the CFO ensures cash flow planning aligns with asset life. If a market drop causes a $50,000 impairment, this hits the quarterly results, requiring precise disclosure to keep stakeholders informed. Such detailed management is crucial for maintaining shareholder trust. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out, from initial recognition to eventual derecognition. See how ASC 360 guides each step and shapes the financial statements. By recognizing the right-of-use asset and corresponding lease liability, Meridian Corporation adheres to ASC 360 requirements. This initial entry ensures the lease impact is transparent on the balance sheet, reflecting the company's future payment obligations and the economic benefits of asset use. Recording the lease payment decreases both the lease liability and cash, illustrating Meridian Corporation's commitment to meeting its lease obligations. ASC 360 ensures that the periodic reduction of liability is accurately captured, maintaining transparency in financial statement presentation. Amortizing the right-of-use asset allocates its cost over the lease period, reflecting its usage in generating revenue. ASC 360 mandates this systematic allocation, impacting Meridian Corporation's income statement by recognizing an annual expense that matches the asset's consumption. Accruing interest on lease liability increases the overall lease cost, emphasizing the financing element of the lease. ASC 360 requires this interest recognition, impacting Meridian Corporation's income statement by adding to the expense burden associated with the lease. Market downturns necessitate impairment testing for assets. Here, Meridian Corporation reflects a $50,000 impairment loss, aligning with ASC 360's guidance. This adjustment ensures asset values reflect economic conditions, affecting both balance sheet strength and income statement performance. Lease modifications can impact both liabilities and assets. Meridian Corporation's renegotiation results in a $30,000 reduction in future lease payments. ASC 360 requires adjusting both the lease liability and right-of-use asset, reflecting the strategic financial maneuver in the accounts. At year-end, adjusting entries ensure financial statement accuracy. Meridian Corporation's $10,000 adjustment aligns the lease liability with accrued interest, fulfilling ASC 360's requirements for precise financial representation. This step is crucial for maintaining the integrity of financial disclosures. Upon lease termination, derecognition is essential. Meridian Corporation's adjustment removes both the lease liability and right-of-use asset from the books, closing the accounting cycle as per ASC 360. This ensures the financial statements reflect the true end of the lease obligation. Every Big Four and investment bank interview on ASC 360 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 360 deals with property, plant, and equipment, PPE valuation. It ensures assets are accurately recorded on financial statements, avoiding overstatement. Companies use ASC 360 to test for impairment, comparing carrying amount to future cash flows. A common mistake is confusing depreciation with impairment. Remember, ASC 360 is about maintaining true asset valuation integrity. ASC 360 ensures that asset values reflect economic reality, preventing overvaluation. Without it, financial statements could mislead investors about a company's financial health. ASC 360 requires impairment testing when indicators arise, ensuring accurate asset valuation. Many overlook its role in financial transparency. Memorize, ASC 360 safeguards against misleading asset overstatements. To record impairment loss, compare the asset's carrying amount to its undiscounted cash flows. If carrying amount exceeds, write it down to fair value. For example, if asset carrying is $500K, but fair value is $400K, record $100K impairment. Avoid confusing cash flows with carrying amounts. Key, write down to fair value. Recording impairment reduces asset value on the balance sheet and impacts net income. For instance, a $100K impairment lowers net income, impacting equity. Misunderstanding impairment's impact leads to financial misstatements. Remember, impairment affects both balance sheet and income statement, signaling asset value changes. Indian accounting standard aligns closely with international financial reporting standards, but differences exist in impairment indicators and reversal conditions. International financial reporting standards allows impairment reversals. Indian accounting standard is stricter. Many confuse these reversals. Remember, international financial reporting standards permits asset impairment reversals. Indian accounting standard doesn't. Knowing these nuances helps in global financial reporting. Impairment indicators include market decline, asset obsolescence, or legal changes. For example, if new tech renders equipment obsolete, test for impairment. Common mistake: ignoring external factors. Key takeaway: ASC 360 requires vigilance for market and operational changes impacting asset value. Fair value is the estimated market price, while carrying amount is book value. ASC 360 compares these for impairment testing. If carrying exceeds fair value, impairment is recorded. Many confuse these values. Always differentiate. Fair value is market-based, carrying is book recorded. ASC 360 requires detailed disclosures on impairment, including asset description, impairment amount, and valuation methodologies. A CFO must ensure transparency to avoid investor misinterpretation. Common oversight: inadequate disclosure depth. Key point: comprehensive, clear asset impairment reporting is essential under ASC 360. ASC 360 excludes goodwill and intangible assets, which fall under ASC 350. Confusion arises when companies incorrectly apply ASC 360 to all assets. Remember, distinguish asset types correctly. Misapplying standards leads to incorrect financial reporting. Key: ASC 360 applies mainly to tangible assets. Let's break down ASC 360 basics. It centers on impairment testing for property, plant, and equipment, ensuring assets aren't overstated. This standard applies to long-lived assets excluding goodwill. Key terms include the carrying amount and recoverability test. Events signaling potential impairment trigger a recoverability analysis. Remember, assets are grouped where identifiable cash flows are present. Core to ASC 360 is the two-step impairment model. First, identify potential impairment with a recoverability test, comparing undiscounted cash flows to carrying amounts. If impaired, measure the loss as the excess of the carrying amount over fair value. Fair value relies on market prices. This model ignores the time value of money during the initial test, focusing strictly on cash flow comparisons. For interviews, know that ASC 360's traps often involve misjudging impairment indicators or improper asset grouping. Unlike international financial reporting standards, the U.S. approach focuses on recoverability tests. Disclosures must cover impairment losses and methods. Avoid overlooking asset impairment indicators and ensure fair value assessments are market-based. Projections should remain realistic, with frequent reassessment when conditions shift. These insights are critical for compliance and accuracy. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.